Investing in the stock market can be one of the most important decisions you can make in your life. It can lead to sustained growth, or you could even possibly become a millionaire overnight. Or, worst case scenario, you could be margin called and end up in immense debt. Hey, this is Joshua. Welcome back to my channel. So let me start off by saying this. This video will be a very, very entry-level introduction to the stock market. We will talk about what is a stock exactly, how does a stock maybe get its value, why are some stocks tradable and others aren't, what is an IPO exactly, and we'll even talk about how does a company benefit when their stock price increases. Now, if you're someone doing multi-leg spreads or selling cash secured puts, this video is not for you. Go ahead and click away now, but before you do, hit that little like button on the way out, because this video is going to be more for someone who maybe just now wanted to start getting into stocks, someone who maybe wants a refresher, or someone who hasn't even bought a stock yet and they're looking into it. But before we begin, make sure you smash that like button and subscribe. Every like that I receive helps make sure that my wife will not leave me for somebody with a real job. So it helps tremendously. So please hit that like button. All right, I digress. Back to the video. So what is a stock exactly? So a stock is a security which represents ownership in a company. The smallest unit of measurement of a stock is what's called a share. So the more shares that you own means the more you own of that specific company. Stocks that are from publicly traded companies are tradable, which means every time you buy a share, you're buying it from someone directly or an institution. And every time you sell a share, you're selling it to somebody directly or to an institution. Stocks are accessible to be traded through something called a brokerage. And there are many different types of brokerages out there. For example, there's Robinhood, Webull, TD Ameritrade, Fidelity, Charles Schwab. There's a lot of different brokerages out there. So I recommend before you dive into this, do some research on what brokerage best suits your needs. So I personally believe an important thing to know is what gives a specific stock its value. So a stock can be valued a shitload of different ways, but the core of its value comes from its fundamentals. Some of the examples of these fundamentals are how much revenue the company is making each year. This is the total amount of money the company brings in. How much profit does the company make each year? This is the money left over after revenue when expenses are deducted from revenue. How much potential growth there is for a company. This is how much more room does the company have to grow? Does the company offer something unique? How does it separate itself from its competition? How much market share does the company have? And does it have great intangible assets like brand recognition? These are some of the core fundamentals that determine the value of a stock. Now, most of this information can be found in the company's financial statements. You may be asking, where the hell do I find financial statements? The best place to find these financial statements is the SEC.gov. They have a search tool called Edgar, which is very helpful. It helps you find all the new documents that have been filed by each company just by searching up their ticker. Also keep this in mind. This isn't the whole picture when it comes to determining the price of a stock. There's other things that come into play, such as hype and momentum, or maybe economic forces such as policy change, overall health of the economy, and many more factors. So you may be asking, how can I buy some companies but not other ones? Well, this is the difference between what's called a public traded company and a private company. So publicly traded companies are accessible to everybody, the average Joe, you and I. We could all invest into these companies through, different types of brokerages like I talked about earlier. The difference between this and what's called private companies are private companies can only be invested by accredited investors. So we, the average Joe, you and I, cannot invest in these companies at all. Seems a little unfair, but it's how the system works. So check this out. A private company can decide to go public through something called an IPO, initial public offering. So this means once that private company has that IPO, that initial public offering, it is now considered a public traded company, which means you and I can trade into this company. You may be asking, well, what benefit does the company have to go public? Well, every time a company goes public through an IPO, they get to raise capital, and this capital can be used to invest back into the company or maybe pay down debt. But I also believe it's important to understand this. When a company's stock price goes up, say from $20 in its IPO to $30, this has no direct benefit to the company, but it does have indirect benefits. You see, companies only receive capital from their first initial public offering. That's the only time that we'll talk about right now. I'll talk about the other time that companies will receive money from their stock. So if the stock goes up, say tomorrow after their IPO, there's no direct benefit. But I'm going to talk about the indirect benefits or how they could possibly make capital off of the rise in their stock price. So these are the different ways that a company may benefit indirectly from an increase in their stock price. One is if their stock price goes up, they can use this as a bargaining tool for acquisitions. So if they want to acquire a smaller company, they could sell their shares, which are now at a higher price, so it requires less of these shares, to buy the company. So they use the shares to buy the company. And like I said, if the price of the stock is higher, it requires less shares to buy the company with. The second way that a company may benefit indirectly from an increase in stock price is there's something called employee stock compensation. Employee stock compensation is when a company pays their employees with their stock as like a bonus. This helps keep the employees happy and it motivates them to make the company succeed overall because they have a stake within the company. If the stock price is higher, this requires less shares to be given to their employees to make the employees happy overall. A third indirect benefit to an increase in stock price is it makes a company less vulnerable for a takeover by, say, another company or an investor. And the final way that a company will benefit from an increase in their stock price is something called a secondary offering. So a secondary offering is a company creating more shares to sell to the public. And if that stock price is higher when they do their secondary offering, they're making more money, more capital for them to use. Now, this is a double-edged sword. The reason why is when a company decides to do a secondary offering and sell more shares, this dilutes the existing stake within the company that other investors may have. Because there's more shares available, the supply is higher, the demand is lower, and your stock that you own will decrease in value. This typically will piss off investors, but if you're holding this company long term, this could actually be a beneficial thing. The reason why this could be beneficial is that they use the capital that they raised in this secondary offering, they could use it to reinvest back into the company, which will create more sustained growth, or they could pay down debt, which makes the company more viable. Now, with all that being said, there's still a shitload of information out there. You may be asking, what the hell is a put? What the hell is this call? What's an option? What's margin? There's a lot more information out there, and I promise I will get to all of it. I'll create an intermediate video, which I will talk about some of these things as well. But like I said previously, this is an entry-level video for the most basic stuff. So if you like this video, maybe consider liking it. Hit that like button or subscribe. Or shit, maybe you can even hit that little bell, that little notification bell, because that will tell you when I create more videos, it'll instantly pop up on your feed. And if you want to be a real, true sweetheart, you can check out my Patreon. Link is in the description below. Anything helps. Just smashing that like button helps. So I really appreciate it. But with all that being said, I hope you enjoyed this video and I hope that creates some sense of value. Now have a wonderful day and I'll see you next time.